All right, this is being recorded. And again, one thing I mentioned at the beginning of every single webinar, watch this again. And you don't necessarily have to watch the high volatility strategy on the short call spread. I am going to drill down more into volatility with this webinar than I do in some of my other ones, but I have done short call spreads in other webinars. So if you want to watch another one and not the exact same one, then yeah, you go off and you can find those as well. But if you're really new to options, I'd probably stick with the same one because some of the nuances might slip by you the first time. The second time through, you'll remember it better and you'll catch some of those things you missed. 416 trouble, but 16 million no problem. I'm not following you, Banu. All right. So this is going to be on the short call spread. High volatility strategy. The time we want to implement this strategy is in and around high implied volatility. I'll show you how to figure out when it's high implied volatility and when it's low implied volatility. And one thing somebody was, we were talking to somebody and it seems like everybody out there really wants to find the fast money, right? What's the easiest money to get a hold of? How do I trade and get in and get out? Well, the easiest way to find fast money is to know value when it's overvalued and undervalued. And that's as simple as it gets. And we're going to talk about that. We're looking for overvalued volatility. And when volatility spikes, it has a tendency to get overvalued in that fear gets exaggerated too much. So when it's over amplified, that's when we want to jump in, because when that volatility comes out, we can immediately take advantage of it. It's the fastest money you can get a hold of. All right, go over a couple things real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading in college with some money I had earned and then moved to Chicago. In that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Last thing to go over real quick is this disclaimer. It says any opinions, news, research, or analysis or other information provided by ProTrader Strategies, associated companies, and or employees is for general commentary and does not constitute investment advice, okay? I would have to know what's in your portfolio. I would have to know your risk parameters and several other things in order to be able to give you guys investment advice, okay? Without knowing all of that stuff, there's no way I can give you investment advice. Well, what I am here and I can do is teach you guys strategies and rules in order to implement those. And then when you find that same situation or a similar situation in and around that you can implement this strategy, that's what we're trying to do. So when you're out there looking on a daily basis, you don't have to necessarily see what I've done or follow my market assumption. If you don't believe my market assumption, which is quite possible, then go out there and implement the strategy in relation to your market assumption. And past performance of any trading system or methodology is not necessarily indicative of future results. I don't know if I said that already or not. You can follow me on Twitter at Wolfman's Blog or our parent company at ProTrader Strat. I would normally say you can follow me at Wolfman's Blog to find out some earnings trades, but because of jury duty, I missed a lot of them this last week. But going forward, I will be tweeting out what my earnings trades are. I'll give you kind of what I'm doing, whether I'm shorting it or, doing a short call spread or, short puts outright. You're going to need to know where my strike location is due to my rules, but that's about it. I don't want to give those out to everybody because they haven't followed my rules, Quick money, right? We talked about that, knowing value. If you see me saying I'm selling a short put, you know exactly my strike location, right? But if you haven't watched the webinars, you are probably a little bit fuzzy. All right, this is the short call spread. We need a bearish assumption. It can be market neutral. We won't get hurt on a market neutral assumption. Obviously, if we have a bearish assumption and that comes to fruition where the market actually does tank down, we will be able to capitalize on that quicker than just taking the theta decay that comes out of this every single day. There's a lot of benefits to doing short call spreads. short strategies. And some of that is that you can be directionally wrong and still make money. So we do want a bearish assumption before entering this strategy. We wouldn't want a bullish assumption because that would put us in jeopardy, but we want a bearish assumption. If the market stays neutral, that's fine. Or if you have a market neutral assumption, I don't necessarily have a problem with you putting this strategy on. I think there's some other better strategies, higher probabilities if you have a market neutral strategy, but, or a market neutral assumption, but you can do the short call spread with that. Oops, skipped one. All right. These are my essentials to success. One is picking the right underlying. Hold on one second. Let me shut this door. Got a kid coming home. Dogs don't realize that it is not an intruder, I guess. All right, so picking the right underlying. What I usually talk about with picking the right underlying, it's one of the first things we need to know whether or not we can even implement a strategy in and around this. So what we need to do is pull up our trading platform, go to the trade window. If it's Costco, picking the right underlying, what we would need to do is, if it's a stock over $100, move the decimal 3 ticks to the left, and 21 cents is how wide our bid to offer should be. That being said, right now after this is during open market operations, you need to double check on this, but usually Costco is pretty close to 21, 25 cents wide. So that would be, if it's inside of 21 cents, that's a green light. You know, if it went out a nickel from that on this, then I would say that would be a yellow light. I'm not saying that you can never trade something that goes outside this rule, but know that if it fits my rule that I'm talking about with picking the right underlying, there's a lot of volume and open interest going on in and around that underlying, which means you don't have to give a lot of edge to get in and get out. Like, for instance, with Costco right here being 50 cents wide almost, you'd think that, you know, normal markets, you would have to give up maybe 20 cents to get in, and I'd have to offer $4.50, hope somebody betters that market. I might end up at $4.40, you know, giving up 30 cents of edge to get in. Well, that's a lot of edge to give up, especially when I think about just theta ticking away. You know, if I had to give up 30 cents, that's almost 5 days of just theta contraction to get to break even, right? Theta, this loses 7 cents a day from this strike. 7 times 5, 35 cents. So almost, you know, 4 or 5 days to get to break even. That's a long time to wait in order to have that happen. I'd much rather give up a couple of pennies on the outside in order to get involved, if you will. So usually if they're really wide, you have to give up 30 cents to get in. You're probably going to have to give up that 30 cents to get out of that trade. That's a 60-cent swing. And almost then we're talking 9 days or something like that you got to be in this trade just to think you're getting break even. All right. So stay away from really wide markets in the options montage. Option montage is just this page, everything involved in it. So for Costco, any stock over $100, move it 3 ticks to the left. 21 cents should be what it is. You know, something like Twitter, it's under $100. So the bid ask should be somewhere inside of 10 cents. So any stock under $100, we want the option montage to be inside of 10 cents, which you can see with Twitter, that works out. So under $100, 10 cents, over $100, we just move the decimal place 3 ticks to the left. You know, so something on booking.com, as you can see here, it'd be like $1.80, maybe $2 wide for the option montage to make that the right underlying. So that's what we're looking for. Tight bid ask, because with tight bid ask over here, that means it usually is reflective of a lot of volume and open interest. And you can see the open interest in and around these options are quite robust. And on any given day, a lot of trading going on. Whereas you could look at something very similarly priced, maybe ADM is not going to have that kind of volume and open interest, right? You can also see that the markets are slightly wider. Not terrible. They still fit the rule, but slightly wider than what we were seeing in Twitter. So we want a tight bid ask because that is reflective of the markets showing volume and open interest in a sense. All right. So picking the right strike. This is really important. We're going to start out with the 36 delta. Now, when we're just doing the short calls, we start out at the 16 delta. which is why I say the short calls, despite the fact that everybody out there says that there's way too much risk in naked shorting and stuff like that. Well, my probabilities on the naked short call are 16% probability that I'm going to lose on that trade. This has got about a 36% probability that we're going to lose on this trade. But we have defined risk. So, we're going to be collecting about the same amount of premium, but we have defined risk. So that is the benefit. We have a lower probability of success, but we know our risk parameters. So that is a safe type situation for some people. But having said that, with that 36 delta, we have about a 65% probability of success, which is better than just going out and buying a stock or shorting a stock. So your probabilities are better there anyway. And when we're building this out, we start with a 36 delta or somewhere very close to that. We want this spread. We want to at least collect 33% the width of the spread, right? So if it's a dollar wide spread, then we would want to collect at least 33 cents for it, right? Right. And then that would make our probability of success about 66%, right? So what you do is you do the risk, which is, if we did our example here a second ago, let me find my calculator, on the probabilities. What we do is we take our risk and divide it by the width of the spread. So our risk is 33 cents and divide that by 100. And that equals, whoops, wait a second. It's the risk divided by the width of the spread, probability of success. So why isn't that working out for me? 33 divided by $1. It's still going to give me the 33. But basically, I don't know what I'm doing wrong here. It should be, but basically the 33% probability of the money that we're collecting, we're risking 33 cents, are 66 cents, which is the difference on that dollar, is the probability of success. Should have worked that out. It's basically a subtraction, but it's not working out. It's 66% probability of success. Just trust me on it, all right? All right, so why are we picking that strike location? It's the half standard deviation right here. Follows in line with the half standard deviation. Now, when we were looking at the call spread or the short calls, we were looking at one full standard deviation. So it's a full half standard deviation closer. But with that, we are defined risk on this. So, and I'm looking at the put side there. This would be considered the call side because it's positive, negative side being the put side. So the calls, the 36 delta. And the way that I come up with that 36%, 33%, you add up all of these. You got 16 plus percent out here, plus a 15%. That gives you about 31, 30 some odd percent. So it's right around that half standard deviation move. Yes, Banu got it for me. I was struggling. The risk is $1 minus the 33 cents that we collect is the 66 cents, which is our profit or our loss. So our risk is divided by the width of the spread, and that equals 66% is kind of the way that comes out, as confusing as that may be. All right, so one thing about this, we almost never have a standard deviation bell curve that looks like this, because with options, people, will have a tendency to buy puts to protect some of their stock, okay? And what they do when they're buying those puts to protect their stock is pumping up the premiums, right? And when those premiums start getting pumped up, it skews the volatility towards that side. So rather than having a perfectly straight, which you do have every once in a while, flat or normal bell curve, you'll start getting some with the skew like this, negative skew. That means that there is put pressure. And the positive skew is that there is call pressure, meaning the calls equal distance away from where the underlying is trading. So if we had XYZ trading 100, meaning that if there was no skew at all, like what we were talking about with this one, if we're talking about this being the 100 strike right in the middle, 0 being the 100 strike, and this being the 105 strike, and this being the 95 strike, well, these pricing on the 95 puts and the 105 calls should be the same if there is no skew. But when we get the skew equal distance to that, if we're talking about the same thing being the 100 strike, well, if there's negative skew, the 95 puts might be trading, let's just say $2, and the 105 calls are trading $1.50. Okay. So they're skewed to the put side. They're equal distance. The puts are equal distance from where the underlying is trading to where the calls are, right? $5 difference, but the puts are pumped up with more premium. Now, that's not a good example of pricing on this for a $100 stock necessarily, but you get my gist, is that when the puts are inflated equal distance away, then there's skew, negative skew. When the calls are inflated, in that same example, 100 strike, right? XYZ is trading 100. The 105 calls are trading $2 now, and the 95 puts are trading $1.50. Now they're skewed to the call side. And I'll show you some examples of where we actually see that happening. With CMG, I just took a snapshot of this today. You can see it's trading $532.38. Let's just say that that's pretty darn close to $532.50, right? So $32.50, it lands right in between the 530 puts and the 535 calls, right? But look at this. It's only off by 12 cents, you guys, and it's off by 12 cents closer to the puts. But look at these puts. These puts are priced much less than the calls equal distance away. Even if you go out to the 525s, 24, and you go up to the 540s, you can see that these calls are worth more than what these puts equal distance away. That means there's skew to the call side. That's where we can take advantage of it, right? You know, you can take advantage of high implied volatility anywhere, but when there's skew even more so, you know, that begs for even more call premium selling, right? One reason is because people have overinflated, gotten over a little zealous to the upside. They're pumping up the premiums here. And I always believe that that is the time to take advantage of it. So look for anomalies like this in the market. If you're looking at a call spread that would, you know, despite the fact that the broader market is calling for a bullish move in CMG, usually the market has overpriced that move due to volatility. Volatility has a you know, I always say this, volatility is overstating, all right? And that's what we're seeing here, I believe. So with a call skew in CMG, I have a bearish, you know, I'm just saying, let's just say I have a bearish market sentiment in, or a market assumption in CMG. Well, this would be a good scenario because I know that these are overinflated because they're skewed to this side. Now, if we looked at something where we have neutral skew, we could look at NVIDIA. And let's just say this is pretty, can we call this as close to, you know, 145 as you're probably going to get on any given moment. So let's just say 145 is the strike, right? It's a little bit lower, but that's the at the money. If we just go $5 lower, you can see these are trading $7.25-ish. And then we go $5 higher, and those are right around $7.25. That's pretty darn close to skew that is neutral or neutral skew, okay, like we showed in that very first bell curve where it's just a normal bell curve. And then if we were going to look at put skew, we could go over to Costco and say it's trading $210, which is as close to $210, slightly to the upside. But you can see, you know, it's closer to these calls than these puts by 60 some cents, but these puts are trading higher than the calls, which means they're skew to the put side. All right. So that's just a little bit about volatility skew. And I usually don't go into that much detail in the call spreads and stuff like that, but Great examples today. I screenshot these today for finding that skew in options. And rarely is it just neutral curve. It's usually going to have a skew, and usually the skew is to the put side, as people are normally long stock and then buy protection. Okay. And then, so that was finding the right strike, picking the right duration. Now, what I was mentioning earlier, we want to take advantage of this theta contraction. We want it when we're selling premium, we want that theta to come out of it consistently, and we want it to come out, you know, even more precipitously than before. And as you can see, when you're way out here on the curve, you know, 90 some odd days or 100 days out, we're not getting that much theta decay. This might be 1 or 2 pennies a day. We get inside of here, and you saw that one example I was showing, we're inside of 45 days. It's 7 cents a day on some of those strikes, right? So we want that 7 cents a day to come out of it because we sold premium. We want to sell it high, buy it low. And that's one of those situations where we were talking about, if the underlying doesn't move at all, we can take advantage of just the theta contraction or the time coming out of this premium. 7 cents a day in some cases. And the closer we get to expiration, that starts increasing. It'll go from 7 to 8 cents to 9 cents a day to 10 cents a day sometimes. All right. Depending on how high the underlying is trading, how high of a, you know, if it's a $10 stock, you're not going to see that kind of theta decay, but on, you know, $100, $200, $300 stock, you will. And the closer we get to expiration, it starts accelerating. One thing to note, you can see it really accelerates here, and you're going to be probably asking me, why aren't we just selling premium strategy over here? Well, one, there's a lot of gamma risk in there. Gamma is going to affect our premiums a lot more inside of this area here. That will make our premiums jump around a lot. I'd rather get out here, have that nice solid move down, not really have gamma affecting it very much, because gamma is more of a gamma trade, to be quite honest. If you want to take advantage of gamma, you want to get it. You want to watch some of my gamma trading webinars, to be quite honest. But right in here, 35 days to expiration, as you can see, is the best timing. Right now, we're right at 42 days here. I usually just tell people you want to go closest to 40 or 35 days as you can, you know, so if that was 28 days, that would be another situation. You just want to try whatever option is closest to 35 days to try and get in on this theta acceleration. Okay. And picking the right environment. We have to have high implied volatility, you guys. There's no way around this. When we're trading short call spreads, we need to have the premium inflated as much as possible, because for one, it allows us to get really far away from where the underlying is trading. You know, when there's really low volatility, you're going to have to get really close because the probabilities of it making an outside move is relatively low. When volatility is really high, they're expecting a really big move, and usually it falls short of that, okay? Because volatility is usually overstated. So when we're looking at picking the right environment, we want implied volatility percent to be above 50 for a stock and above 30 for ETFs. The reason why ETFs are a little bit lower is because they have a tendency to have a lot of different stocks, or they have to have a lot of different stocks in there. And those volatility coefficients will average each other out and kind of make them a little bit lower. So that being the case, they don't really jack up really fast very often. All right. So picking the right environment, we want implied volatility percent right here, IV percent, to be above 50. Now you can see, because we've experienced this really high volatility recently, it's hard to get up above that IV percent of 50, especially when there's no earnings. So when we're giving examples today, we're going to pretend like there's no earnings in there to get that high volatility for our example. Yes, you can trade this around earnings. I have specific rules for earnings trades, so please check that out, rather than doing this trade around earnings when it's like 6, 8, 10 days away. I would not suggest that at all. All right. You want to get that volatility when it's highest and sell it then, because after that binary event, you know it's going to go down. And when volatility is really high, you expect it to come back down to the median. Just like when it's really low, you would expect it to start going back up, right? So that's what we're looking for. Implied volatility above 50. And when that volatility reverts back to the mean, we'll be able to exit our trade. Implied volatility percent, not everybody has. So basically what you have is a numerator and a denominator. And in the numerator, you take the sum of where current volatility is, which is 25, and subtract it by the low, which is, in this case, 15. So 25 minus 15 in the numerator is 10. And you take that sum and divide it by the high minus the low, which is 35 minus 15. So in the denominator, we have 20. 10 divided by 20 is an IV percent of 50. So you can see ADM is right there at an IV percent of 50. So again, in the numerator, you take the sum and divide that by the sum in the denominator. In the numerator, you take the current IV minus the low IV and divide that by the sum of the high minus the low to get your implied volatility percent, all right? And I have the code base that you can put in here to customize this to make ID percent over here. Because to be quite honest, when I'm looking at this, you guys, for a strategy, if I'm like looking for a bearish strategy or a bearish assumption or something like that, first thing I'm doing is looking at these high implied volatility ones and then starting to narrow down from there, like what's overdone to the upside, what do I think is going to correct to the downside, right? You know, CMG, I could say it's overdone to the upside. I would want to play it to the downside. I might use that as an example here pretty soon. I can't remember where their skew was though. And finally, knowing your exit strategy before entering that trade. This could be one of the most important rules I have, you guys, because so many people don't follow this. You know, a lot of people will look at a strategy and are put on a strategy and never really know where they're wanting to get out of it. Like, I believe I'm right and I'm going to get out of it when I know I'm right. Well, how do you know when you're right? How do you know when you should exit? My rule for exiting any strategy, and especially this one, the short call spread, exit at 50% of max profit. Now, we talk about this on just the naked strategies also, right? If you just sell this strategy for 33 cents, getting, you know, a dollar wide, 33 cents or 33% or a third the width of the spread, it's going to be hard to make any kind of money in this with the commissions getting in and out. So you might need to increase that a little bit for those really small premiums that you collect. But normally 50% of max profit. So if I sold it for $1, if I collected $1 on, say, a $3 wide strategy, which would be a third the width, right? And I collected $1, I would be getting out of this when it was trading at 50 cents, okay? And on the upside, because it's a defined risk strategy, I'm just going to let the probabilities play out. I'm going to take the full loser on it if I have to, because I don't believe that it would be a full loser if I held it to expiration. If anything else, it's probably going to be a partial loser, or the market will come back and my probabilities will be intact, where you know, it's only a 33%, 36% probability of being the money. I'll let those probabilities play out to the end. But write everything down, what you're going to do, why you entered this trade, what the underlying was, the duration you entered it, what your exit price is, okay? All of those things need to be written down so you have data to go back and look at to make sure you are, you know, for one, your probabilities are good, and that you're staying mechanical. When you write it down, you'll be mechanical. If you just kind of give yourself the, I'll get out when it's at 50%, when it gets there, you're going to have a tendency to say, I'll get out when it's, you know, 75%. I'll get out when it's 80%. And all of a sudden you're going to see something go awry. Get out when you say you're going to get out, and stick with that. You'll be much happier, more mechanical, and more profitable going forward. All right. Our max profit on a premium selling strategy is the premium we collected. That's no way around it. Anytime you sell premium in options, that is your max profit. So the premium minus the commissions paid. And then our max loss on this, we've gone over it a little bit, is the width of the spreads minus the premium received plus commission. So, all of that together is going to be right around your max loss on a dollar wide is about 60% the width of the spread, right? And then our break even is going to be that short call strike plus the premium received. So when we were talking about, let's just say we were selling the XYZ at 100 and buying the 105s calls to define it. We're short the 100 calls, long the 105. We have collected about 80 cents for this strategy, let's say, because that's about a third the width of the spread, right? Isn't it? No, about $1.20 something, sorry. And in that, then our break even would be that 100 short call plus the premium received. So 100 and 125 in a sense, right? So whatever our premium received, add that to the short call. That's where our break even is. All right, so let's go over a couple examples so we make sure we're all clear on concept. We'll go through each underlying through my rules, the right environment, all of those things, know our exit strategy, and go with that. So this is the time where I tell you guys, throw it out there in the questions box. That's how we're communicating. If you guys haven't been able to get a hold of me, in the questions box, throw out your favorite stocks that you would want to short. Okay, we have a bearish market assumption in. I'm just going to say I have a bearish market assumption in Chipotle because I went there and ate and I got sick, and I don't know if it was another bout of whatever was plaguing them before, right? So let's just play Chipotle to the downside. We discerned that there is skew to the upside, right? Yes, there is skew because this is as close to about $5.30. You can see the $5 higher versus the $5 lower are priced higher, right? So the 30s to the 35s, 30, and then from the 30s. So the skew is to the call side, right? Because if it's 530 right here, $5 lower is $25, $5 higher is $27. So there's skew to the upside. People are expecting this to go higher. I'm going to fade that. So let's say we got the high implied volatility. I've got my directional assumption. One thing to look at, Chipotle, move this 3 ticks to the left, 50 cents. Our market's 50 cents wide on the spot month, closest to expiry. It's a little wide. We would have to check this during open market operations to see if it fits. I think that Chipotle usually fits my rule here. I don't know. It's a dollar wide though today. But let's just look at it anyway. Actually, you know what? You guys, I think, have some better examples. Let's look at Cisco because that doesn't fit the rule, right? We have high implied volatility, but it's not fitting our rule. It's just I'm going to have to give up 50 cents maybe to get into this and 50 cents to get out. That's just too much for me right now. So let's look at Cisco. We have, sorry, I don't know where that came from. Cisco. All right, so Cisco, we can look at the charts. Okay, we got no earnings. We don't have to worry about that. I think they do, but we're going to pretend they don't because it doesn't show it up, right? It's a little bit below IV percent of 50. One thing to say that we had this tremendous spike in volatility. You could say that is a yellow light, green light above 50. Just slightly below it. Just know that you're getting into the iffy area. Under $100 stock should be 10 cents wide. That fits this rule. We start at the 36 delta and sell that one. We'd want to look at a dollar wide to buy, and we got 34 cents. So we've collected a third the width of the strike on this strategy. So that works for Cisco, right? Knowing that we have a yellow light there, that's a bit of an issue, right? We'd much rather have much higher volatility. We could look at EA Sports since it has super high implied volatility. It's a $92 stock, so inside of 10 cents. This usually fits that rule. You can see here some of them really close or a little bit off, but let's just say it works because I think it does normally. Look at that 36 delta. We don't have exactly a 36 delta, so I'm going to push it a little bit further out. Sell this one, buy $5 wide, and we're collecting a $1.06. And I think for what is a $5 wide, we need to collect a little bit better than that. We need to collect like a $1.65 or something like that for a $5 wide, because $1 wide, $5 wide. $1.50 something, $1.60 on this. Because if it's $5 wide, a third, right? 5 times 33 cents should give us about $1.60. So that's too low. I would want to collect a little bit more than that. So I'd probably pass on that one. Somebody else was, what is that? Square. I don't recognize SQ. What is SQ? Square. All right. So Square should have 10 cents wide. It fits that rule. So let's delete this one. Looking for that 36 delta. We don't have it. So I'm going to default a little bit further away. $1.20, it's going to make me go a little bit closer to get to that. So if I really wanted to short it, I'm going to have to go a little bit closer to get that $1.60. So I want to at least collect, a third the width of the spread, and that's what I'm going to have to do. So with that, if I was worried about that at all, I would probably come out here and just sell the short calls in that case, right? And get further away, higher probability of success. But, if you're willing to take that and you're really bearish in it, then go with this one because that fits that rule. You start out with the 36 delta and then try and go further away if you can. But if it doesn't fit my rule on the third the width of the spread, you're going to have to go a little closer. And then at that point, decide if it doesn't work, should I go further away? Okay. AMD is another example I think one of you guys threw out there. I see a couple questions coming up real quick. So AMD, $24 stock. It's going to be really hard to get this third width. It's going to be close, 34 delta, 24. So this is the example where you get it below a $50 stock and it makes it really hard to get that third. Plus it's way below a 50 IV percent. So I'd stay away from that. We'll look at Twitter real quick. And I see your example also, Banu. I'll get to that here in a second too. Let's try Twitter. So Twitter, if we were bearish, we would look at that. $33 stock should have 10 cent wide markets. It does. Bearish market assumption that no earnings. At least it looks like it doesn't here. I know there is earnings, but all right. So go to the 36 delta. 34 is as close as we can get. So we want to sell that one and then buy the next one out, 27 cents. It's a little bit rich. I'd have to probably go to the 40 delta and come back out, and that gets me my 30 some odd dollar ones. Okay. And somebody was saying net tap. Manu, I think, was saying net tap here. Implied volatility over IV percent of 50. That works. Cancel charts. Looks like there's no earnings. We're pretending there's not. So we'd go try and find that 36 delta. It's $5 wide. I'm going to have to go pretty close because I can see right here it's not going to give me that $1.60, right? So I need to go to here to get that $1.60. Markets are pretty wide in here, though, to get to that. So if you trade net tap a lot, then I would say you're okay with trading this. Just know that because the markets aren't tight all the time, and I don't think that they are, generally speaking, necessarily going to always fit that rule. Just know that you're talking about a yellow light. If you guys get too many yellow lights, the spread's too wide. The IV percent is, 45 rather than 50. Now I've got a couple of yellow lights. You got to start worrying about this really being a solid setup for this particular strategy. There may be other strategies out there that fit this rule better. Okay. But just know that you need to collect a third the width of the strikes. All right. NVIDIA, I'll go NVIDIA. All right, NVIDIA we would look at and see that they don't have a chart pulling up. Way to go, Joe. Way to go. Get the one that doesn't work. We might not be able to show this example. I don't know why my platform's jamming up on me. Come on, NVIDIA. I don't know why. Sorry, Joe, we're not going to be able to do NVIDIA. You're welcome. Thank you. Yeah. It's like a good lawyer. Never ask a question you don't know the answer to. And during jury duty, I saw my lawyer ask questions she didn't know the answer to. And it was pretty funny when she got caught off guard with the wrong answer. All right. So I'm not going to be able to pull up NVIDIA. So let's get down to brass tacks then. We've got this offer for you guys. It's a great one. Look at this. It looks funny here. Why? Because we're jamming two offers together. The floor trader hacks, all of these hacks over here will save you time and energy, like the probabilities of being in the money, the probabilities of being kissed, all of those things. I'm trying to shorten your time frame. You know, one of the things we talked about at the beginning of this is how do you make fast money? Well, fast money is made if you can determine value faster than somebody else. And by getting information faster than somebody else or figuring it out faster than somebody else makes you react faster, gets you ahead of everyone else. That's what we're trying to do with these floor trader hacks. I make it so much easier for you to look at the option montage, look at all this other, all these things that are going on in and around options trading to make your decisions faster. Okay. You don't have to pull up the calculator all the time and punch it in. And then we also got the Trading Volatility Crush. This is a completely new webinar where I built this out. This is hours and hours of content that you guys will be able to take advantage of. So for both of these, you're getting both of these for the price of one. Usually we're charging $497 for all of them, or for just one of them on a deal. We're giving you, because this is a brand new, this is a brand new one over here on this side of the offer for $497. So you get both of them for one. So like if you guys want to learn how to trade and be more consistent, know how to be confident. If you guys know all the information in and around when you're building these strategies, when you enter them, you will be more confident because you know the probabilities and everything else. All right. So when we are determining value, whether it's overvalued or undervalued, I talk about all that stuff in here and how to trade these option volatility coefficients well. All right. So how to calculate volatility crush, all of those, how to take advantage of it, selling premiums. It's going to save you a tremendous amount of time over here. For one, you guys will be able to understand it. So check that one off. And then over here, you guys are going to really get into the volatility crush and how to take advantage of that, because that's where the fast money is made, when volatility comes out quickly. So what I usually say is pause this video, but we can't. It's in the chat window. So for you guys that are watching this, go ahead and click on the chat window. We've been communicating in the questions box. In the chat window, there is a link to this. If you're watching this on tape delay, you're going to have to pause, type this into your URL to take advantage of it. So easiest way to do it is to jump on that. It'll take, that link will take you to this page. Just fill it out. And as you can see, you get both of those in your cart for the price of one. You can't beat it. Later webinars, I'm going to be drilling down on different option components, when and where I find those option trades appropriate. You can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. Seriously, guys, if you guys want to learn how to be consistent traders, become more confident, and when you become more confident, you're going to be able to put on more strategies. And when you put on those more strategies, you're going to see the probabilities all of a sudden fall in your favor, and you're off to the races. I talked to somebody not too long ago, and he was basically an algo trader. I'm not the biggest fan of algo traders, but I was talking to him nonetheless. And we were talking about probabilities. And he told me that once he got his algo to being 57%, I think it was 57% right. He had a 57% probability of being right. He became, that's when the snowball started really rolling downhill. He was more and more, he was consistently cash positive. And that's what I do. I try to teach those probabilities. If you can be on the right side of probabilities, you're going to be a more consistent trader and profitable. All right. So that's what we want to get to is profitability. And in order to do that, we need to be more confident and put on more strategies so that when the probabilities beat us on the other ones, we know that we're winning on the ones going forward. So take advantage of this. I mean, this has got to be over 40 hours of content here, you guys. So take advantage of it. I mean, $10 per hour or less is a great deal. You can't beat that for trading or making money, for be quite honest. You'll make that $500 up in a month for sure if you follow my webinars. All right, so that's it. Thank you guys all. That's all I got for you guys, other than if you can't take that, take it easy. Have a great one, guys. Take care.